Will dollar swap lines stop economic Armageddon? I'm going to explain this to you in 3 simple, fast steps. Step number 1, let's start by understanding how dollar swap lines actually work. We've got country XYZ, ABC, and 1, 2, 3. You can tell it took me a long time to figure out these names. And of course, we've got the Fed right in the middle. So when trade slows down, global trade, we go into a recession, maybe even a depression, there are a lot fewer dollars circulating within the system. But remember, a lot of these corporations and countries themselves have tremendous amounts of dollar-denominated debt. Why is this? Editor, throw up a chart of the DXY going back to 2011, 2012. Back in 2011 and 2012, the dollar got extremely cheap, all the way down below 75 on the DXY. So all these countries and corporations loaded up on dollar-denominated debt because relative to their currency, it was extremely cheap. Also, during this time, the Fed took interest rates down to 0%. So they could borrow these really cheap dollars at a very inexpensive price. The interest rate was much lower than borrowing in their local currency. And because of recency bias, they thought the dollar was going to continue to fall. Of course, we know, looking back in retrospect, that didn't happen. Today, dollar all the way back up close to 100, which means all these corporations and entities are having to pay back their debts with more expensive dollars, or dollars that have a lot more value relative to their local currency, which their revenue is denominated in. But it's not just about the dollar-denominated debt. These countries and entities also have a lot of suppliers that will only accept U.S. dollars. So the bottom line is, if there aren't enough dollars circulating throughout the world economy, a lot of these businesses, and maybe even some countries, will go bust. Let's look at an example of how this actually plays out. The Fed has a different swap line agreement with every country it chooses to do business with. And yes, I said chooses. Very important distinction. More on that in a moment. But country XYZ, at the time of the transaction, the exchange rate is 2 to 1. So for every $1, you get 2 of their local currency. The Fed looks at them and says, okay, we think you're a pretty good credit risk. We will give you this loan at 2%. And yes, this is technically a loan where the Fed is giving the central bank the dollars, and kind of as collateral, they're giving the Fed the local currency to hang on to. So this particular swap line agreement, $1 goes to Central Bank XYZ. Central Bank XYZ gives the Fed 2 of their local currency units. And the Fed gives them this loan at a 2% interest rate. And again, these aren't actual numbers. I'm just using them for the example. So the Central Bank XYZ takes the dollar, usually gives it to the banking system. The bank lends the dollar to Corporation XYZ so they can pay their suppliers. And again, the reason they need this is because they receive revenue in the local currency. They pay their employees in the local currency. Pretty much everything they do is done in the local currency, except a lot of their debt payments and there's foreign suppliers. So they give this dollar to the shipping company, and the shipping company takes their goods and brings them right over to the United States so we can consume the goods they manufacture, and we don't have to produce those goods ourselves right here in the United States. It goes back to Wednesday's video. And another example of how this might play out with country ABC. It's the same process, but let's say the numbers are slightly different. So the exchange rate here is 4 to 1, so 4 of the local currency units to $1. The Fed sees them as a little bit higher credit risk, so they're giving them a 3% rate of interest. The central bank takes the dollar, goes right into the banking system. They give it to corporation ABC, which instead of using it for shipping costs, they use it to buy more oil to manufacture the products they need. Then going to the last example with country 1, 2, 3, a little bit different here. Yes, the numbers are different. They have a 3 to 1 exchange rate, a 2.5% rate of interest. But here, this corporation 1, 2, 3, doesn't have many suppliers that need dollars, but they've got a lot of dollar-denominated debt. So they might get the dollars they need straight from the central bank in kind of a program set up like the Fed's alphabet soup. It gives them the dollars they need to pay their debts to the bank that gave them the dollar-denominated loan in the first place. So while the Fed is setting up these alphabet soup programs right here in the United States, it's also doing it outside the United States. So these central banks of other countries can come up with their own dollar MILF programs, just like we have right here in the United States. There are all these mini MILF programs. But I want to also point out, before I go down that rabbit hole, that these loans have a term. They're either 20 days, 30 days. I think they go up to 90 days. But I've read that the countries can roll these loans over. It's extremely important because if we continue on with the cerveza sickness wreaking havoc in the global economy, the Fed has already stated that it most likely will allow these countries to roll them over into longer terms, very much like repo agreements. To explore this further, let's go right to the internet. The swaps provide participating central banks with dollars in exchange for their local currency. As an example, the Fed provides US dollar to the Bank of Japan in exchange for an equal value of Japanese yen at the current market exchange rate. The Bank of Japan then provides the dollars to institutions in its jurisdiction, namely Japanese banks, who in turn channel funding to their clients. And I'm using Japan as a specific example for a reason. More on that in step number 3. The swaps unwind at the end of the maturity period and can be extended or rolled over as long as the facility remains open. And I think this is going to be just like the Fed's intervention in the repo market or quantitative easing. It's supposed to be temporary, but 10 years down the road, they're still doing it. And like the repo market, it's just a temporary glitch at the beginning, and then all of a sudden, they're doing or committing to $1 trillion a day. Ideally, when market conditions have normalized, which again, I doubt they will, the central banks unwind the swap. The Fed gets back its dollars. The Bank of Japan gets back its yen using the same exchange rate used in the initial transaction. So you can see the main takeaway from step number 1 is these transactions, these dollar swap lines that the countries and entities outside the U.S. need so badly because the dollar is the world reserve currency, gives the Fed and the United States a tremendous amount of leverage. Not only do they supply the dollars, but they can also pick and choose which countries get the swap lines and at what rate of interest. More on that later on in the video. Step number 2! Of course, there are unintended consequences to these dollar swap lines. Now, first and foremost, you may be asking yourself, George, you forgot to go over this balance sheet of Japan. Looks like they've got some interesting things there. U.S. treasuries and, of course, funny money like every central bank has on their balance sheet. But this is my teaser. I left it there purposely because we're going to discuss this in step number 3. And this could be the way that we expose the Fed and their dirty tricks with these swap lines. But you're going to have to stay tuned to the end to check that out. So, going back to the unintended consequences, the Fed sets up swap lines with country XYZ and 123, but it doesn't set up swap lines with all the countries who need them. Insert country FU Fed. And of course, they have their fearless leader, King FU. King FU doesn't like your drunk, insolvent Uncle Sam at all. King FU thinks Uncle Sam has abused the power of having the global reserve currency, among many other things, like setting up a military base in his backyard. Doesn't like that one bit either. But the bottom line is the Fed didn't give a swap line to FU Fed. So because they don't have a dollar swap line, they don't get the dollars they need. This creates an economic crisis because FU Corp can't service its dollar-denominated debt. FU Corporation then goes bust, and all of their employees can't buy goods and services. You have social unrest, and they get pissed at King FU. Well, he can't have this, so he looks around and says, how on earth am I going to get the dollars I need to run my country so we don't go into an economic crisis? So he looks around his country and he says, wait a minute, we've got this gold mine right here. It's owned by Goldcorp, a U.S. corporation. But at the end of the day, I've got to put my people and the best interests of my country ahead of the interests of a U.S. corporation like Goldcorp. So King FU nationalizes the gold mine. He steals it from Goldcorp. And this is when the reality of these dollar swap lines really hit home for the average investor like you or I in the United States who's interested in investing in commodities and precious metals like gold, silver, and oil. For more on how these dollar swap lines might affect you directly, let's go to a clip from my full-length interview with Marin Katusa.
A country within a positive swap line won't screw with a American listed or an American mining company or a gold company with their gold mines and the foreign assets because they don't want to screw around with those positive swap lines and the established relationship with the US. Now, a negative swap line, and I warned about this, let's take a country like Papua New Guinea where Barrick Gold has a big gold mine, or someone like Newcrest has a very large mine with Lahir. Literally a day and a half after we issued this swap line video, the president of Papua New Guinea is threatening to nationalize Barrick's gold mine there. And Barrick is one of the largest gold companies in the world. It produces over 5 million ounces a year. So if it's going to happen to Barrick or a Newcrest or a Glencore, it's going to across the board. So this is something that nobody is talking about. And George, before I published this about a month ago to my subscribers, and before I started publishing, I started talking to all the, I know the guys in mining, and I spoke to so many of these mining executives of producer countries, and not a single one of these mining executives knew what a swap line was.
Well, it's more of a macro thing.
So
they're kind of bottoms up, and you got to know macro to get it.
Exactly. So this was like a real game changer. And, you know, we can get into the charts later, but it's really an additional layer of risk. So what does this mean? Well, if you're in a negative swap line, you know, you're not just taking the gold and selling it into the international market. What you're going to see, and it's already started in some countries and more are going to follow in the negative swap lines, they're going to force you to sell that gold to the government in their local currency at a fixed rate.
So the Fed is picking winners and losers, and we can see that as governments get more and more desperate, they'll go after whomever has the resources and take those resources to satisfy their own purposes. At the end of the day, the government is going to take care of themselves above any individual or corporation. So we as investors need to look at these swap lines and look at our portfolios and ask ourselves if we have any additional risk that we're not considering because we might own a company that has an asset in one of these foreign jurisdictions. But this is really a warning to all Americans because as we go into a recession, if not a depression, right here in the United States. If things get worse economically, which they most likely will, the government is going to go after you and I just like King FU goes after the gold mine. How do they do that? You may be asking yourself. Well, if they can't afford to fund a pension, what's going to happen to property taxes? If the government can't generate the revenue it needs for all the promises that it's made, what's going to happen to a wealth tax or even a sales tax or a VAT tax? It goes right back to what Doug Casey always says. The government sees you as a milk cow, and if it gets bad enough, they'll see you as a beef cow. Step number 3. Could the dollar swap lines just be the Fed's smokescreen they're using to pull the wool over your eyes? I think the answer could definitely be yes. To dive further into their shenanigans, let's go right to a chart of the 10-year Treasury yield. Going back to 2000 all the way to 2020. On the left-hand side, our interest rate goes from a measly 0.5 up to a normal 7%. In 2000, interest rates right around 6%, but they come all the way down because Greenspan meets with Krugman and they decide it would be a great idea to inflate a housing bubble to make up for the dot-com bust. But in 2003, 2004, interest rates on the 10-year yield gradually start to come back up to a point where they get close to 5%. What happens next? The GFC, a huge recession because the economy couldn't handle the higher interest rate. So the Fed comes in, they drop interest rates down to 0 to combat the recession. The 10-year yield follows, but then it goes back up to almost 4%. But notice it's gradually going further and further down. There's this downward trend. In 2013, it spikes up to about 3%. But then comes back down as we get closer to 2020. It goes back up, but it can only get to a level that it saw in 2013. But then we have the cerveza sickness and rates come crashing all the way down to where they are today, right around 0.6%. But what I want you to notice from this chart is the no bueno zone, which is the level that interest rates can't exceed without crashing the entire economy, gets lower and lower and lower. In 2000, let's say it was right around 6.5%. In 2007, we know darn well it was about 5%, but now it could be all the way down to maybe 1%. So the Fed has to keep interest rates artificially low because our entire economy has been financialized. It's been built around artificially low interest rates, quantitative easing, and printing limitless funny money. And you may be saying to yourself, yeah, George, I get how the no bueno zone is coming down further and further and further, but what does that have to do with the dollar swap lines? I'm glad you asked. Let's check it out. So the Fed not only set up dollar swap lines to interact with these foreign central banks, but they also set up FEMA, which is Foreign and International Monetary Authority Facility. So what this is basically a repo market outside of the United States where the Fed does transactions just with these central banks. What type of transactions are they doing? They're trading treasuries for dollars. Aha. Are you starting to connect the dots? Let's take it one step further and go to a recent article from one of my favorite macro thinkers, Lynn Alden. Foreigners have two ways to get dollars when they really need them. They can participate in international trade, just like we talked about in step number 1, or they can sell their US dollar denominated assets. Aha, here's where it starts to get interesting. In healthy markets, they choose the first option, but during a global slowdown or recession, trade dries up. So when dollar debts need servicing, they are forced to sell their U.S. assets to get dollars. In fact, that's one of the key reasons why international central banks hold foreign exchange reserves in the first place. Currently, country XYZ, ABC, and 123 have $40 trillion worth of U.S. assets. $7 trillion of those assets are treasuries, which takes us back to the teaser, which is Japan's balance sheet. Remember, they've got funny money on the liability side, but U.S. treasuries, and a lot of them, on the asset side. So the Fed has to set up these dollar swap lines, FEMA repo programs, to make sure these foreign countries don't sell their treasuries. Because if they sell their treasuries, the interest rates go up, potentially straight into the no bueno zone. So to answer the question, will the dollar swap lines stop economic Armageddon? I would say in the short term, yes. But the question is very nuanced, because at surface level, what the Fed wants you to believe is that they're preventing economic Armageddon in all of these foreign countries. Where if we peel back the layers of the onion, and if we take the red pill, we can see that the Fed is actually preventing economic Armageddon right here in the United States. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.